From San Diego, California, this is the Frug Life Podcast, the show that teaches you how to save, invest, and earn money. Here's the host, Mr. Frugal himself, Ricky Hirsch.
I've recently been listening to an audiobook, a biography, about the life of Warren Buffett. And in this biography, the author talks about how Warren Buffett made money and about his investment philosophy. Now, as you might know, Warren Buffett had a mentor, someone who taught him, and his name was Graham Stephan. Okay, that's not true. His mentor's name was Benjamin Graham. Anyways, Benjamin Graham had a style of investing that focused on looking at the fundamentals of a company. Specifically, he was focused on finding stocks that were deeply discounted and that were selling at less than their total net working capital. At least this is my understanding of his philosophy right now. Perhaps I need to take time to read The Intelligent Investor. I think that's the book Benjamin Graham wrote, and report back to you in more detail. So Warren and Benjamin Graham looked at these stocks that were selling at extreme discounts and purchased them. And clearly, Warren Buffett has done very well in his investing career. Now let's talk for a moment about the efficient market hypothesis. And we're going to really just focus on the first two levels of the efficient market hypothesis. There's three levels, we only need to get into two. So in the weakest form of the efficient market hypothesis, historical information is integrated into the price of an asset. So what does that mean? In essence, it means that using historical price information is not going to help you predict the price of a stock in the future. So if you are looking at a graph of the price of a stock, up and down, zigs and zags, you can't use that to determine what the price will be in the future. Just because the stock is down now doesn't mean that it's going to go up in the future. And I think the case for this is pretty strong. If you could use that kind of readily available information to determine the price of something, everyone would do it, and therefore it wouldn't work because everyone was doing it. You may also want to listen to my episode Rock, Paper, Scissors Trading, which I think talks about this a little bit more. In essence, the weak form of the efficient market hypothesis shows that technical analysis, as it is sometimes called, doesn't work, which is looking at charts and graphs and using them to predict the future. There's another type of analysis, fundamental analysis, which looks at current data, like things that you would find in the financial statements of the company, and uses that information to make predictions about its performance in the future. So this is what Benjamin Graham and Warren Buffett were doing when they looked at stocks. They looked at key ratios to see if they were investment worthy. It's interesting, though, that at the end of his life, Benjamin Graham seems to have made a statement somewhat to the effect that his methods don't work anymore. And actually, throughout the career of Warren Buffett, there are many times that he would complain that there's nothing to invest in. Particularly in times of high market prices, he would say that nothing was meeting his criteria. This all relates to the famous Warren Buffett quote, "Be greedy when others are fearful, and be fearful when others are greedy." So you might ask, is the efficient market hypothesis true? And more precisely, which form of the efficient market hypothesis is true? I'm not even getting into the third form, which is the strong form. In a sense, Warren Buffett's entire investing career could be interpreted as a statement that the efficient market hypothesis doesn't work in the medium format, we'll call it. After all, how could one do fundamental analysis and achieve above market returns if this was the case? Now, I'm certainly not going to dismiss Warren Buffett as being lucky, because I don't think that's an accurate assessment. I think Warren Buffett certainly does have skill, yet I still generally believe in the efficient market hypothesis. So how is that possible? Well, I think there's a few things to keep in mind. One is that markets aren't perfectly efficient. They're generally efficient or often efficient. And by that, I think I mean a few things. If the markets were perfectly efficient, nobody would need to look at the markets to observe prices and to take advantage of pricing inefficiencies. But if nobody was there observing prices and inefficiencies and correcting them, then those inefficiencies would grow. Said another way, I believe pricing inefficiencies are generally temporary these inefficiencies do exist and people observe and correct them and make money doing so. These inefficiencies just tend to be smaller and exist for a point in time. Second, we've definitely seen some manias recently. We've seen assets like Bitcoin rise tremendously in price. And we've seen companies that invest some of their money, their treasury funds, into Bitcoin, have the price of their securities rise. Now, I will point out now that the market is more able to regulate prices upward than it is downward. To say that in a better way, if you buy a stock, you drive its price upward by increasing the demand for that stock. So as you keep buying a stock, the price will move upward. Now, let's say that you think there is an overvalued stock. How can you lower the value of that stock? Well, if you own shares, you can sell those shares. So that's easy enough. That would potentially lower the price. But let's say you don't own any shares. Well, you could sell shares of a company that you don't own, and that is called short selling. So you'll sell these shares, and later you'll buy the shares back and return them from the person you borrowed them from. The idea is that you buy them back at a later date at a lower price, and therefore make money on the exchange. Now, there's some limitations of short selling. One would be the carrying costs. When you borrow a security from someone, you have to pay for that service. So the amount of time you're in a short position will cost money. And if the security moves in the opposite direction of the one you're predicting, you may also get a margin call where you'll have to put in more money. Basically, when you borrow the security, you have to put up collateral. The amount of collateral you need to put up is proportional to the value of the item you're selling. So said another way, if the value of your stock that you're short selling goes up, you need to pledge more collateral in order to maintain your position. If you're not able to do so, your position is going to get closed, which generally means you're going to lose money because it moved in an unfavorable way. The last thing I want to explore is that markets have gotten more efficient over time, and that the strategies used by Warren Buffett and Benjamin Graham worked in their era and were good. But the markets know these strategies now. Lots of people try to employ them. And I think most of the advantage of using this strategy or these strategies are gone. I'll have to research this more separately and independently, but that's my theory. And we will be right back after a quick break. Welcome back. I wanted to reflect on just a few things for a moment. One is that I used AI to make an alternative version of this episode. I think this version of the episode is actually generally inferior. It took out my Graham Stephan joke. I guess AI didn't think it was funny. We'll see if you think it's funny. It did give me some more particular examples when talking about net working capital. It talked about buying $1 worth of assets for 50 cents. So it added that particular analogy. It also helped me do a few things. One is that medium form of the efficient market hypothesis, I'm pretty sure is called the semi-strong form. And lastly, it gave a kind of interesting example. Let me just share it today. Today, those strategies are well known, widely taught, and employed by countless individuals and sophisticated algorithms. It's like finding gold in a new territory. The first explorers get rich. Once everyone knows where the gold is, it becomes much harder to find those big, obvious nuggets. I suspect most of the easy gains from these deep value strategies are gone, or at least much harder to find consistently. This aligns to what Benjamin Graham himself seemed to allude to later in life. That's certainly something I wouldn't have written myself. I'll let you decide which one you like better. The outro it wrote was kind of interesting too, and I need an outro, so let me share what AI wrote. This is a fascinating area, and one I'm still exploring. What are your thoughts on market efficiency and how it impacts your investing? Do you still believe there are Warren Buffett-style opportunities out there for the average investor? Head over to thefruglife.com and let me know your take in the comment sections for this episode. I guess maybe don't listen to that because there isn't a comment section for this episode on thefruglife.com. Still, go there and check it out if you'd like. There's some other great content there. Anyways, thanks for listening to this episode of The Frug Life. Until next time, stay frugal.